What's the outlook for fixed income? U.S. Bank's Jennifer Vale is going to give her take. Welcome, Jennifer.
Thank you very much, Veronica. Glad to be here.
So, Jennifer, interest rates, everybody wants to know about that. What's your view?
Well, our view is that interest rates are gradually going to be on the rise throughout 2014. We have a strong economic growth, and we're starting to see signs of most of the earlier issues were weather related. So we're expecting to see the 10-year end the year at about 3.4, 3.5%.
So as rates rise, how can people protect themselves? Where are their opportunities?
Probably the greatest opportunity is going to be in the high yield space. High yield is very attractive relative to the other fixed income sectors, primarily because in a stronger economy, high yield tends to perform well as corporations are doing better, improving the bottom line in their balance sheet. Also, out of all the fixed income sectors, high yield is most closely correlated with equities than any other fixed income sector. So as the equity market improves, high yield tends to perform well as well. And then lastly is low default rates. We're below 2% on default rates for high yield. We don't expect that to go anywhere anytime soon. So that low default rate environment and current spread levels relative to that default rate environment actually show that we could have another 30 or 50 basis points of spread compression for high yield. So it's by far our favorite sector in fixed income.
How should advisors be looking at investment? Should they be looking to buy individual bonds, or should they be buying bond funds?
So for individual investors or for advisors' clients, if those clients are very risk adverse and concerned about a rising interest rate environment, those particular investors may be better served by being in a portfolio of individual bonds. And that's primarily because those investors feel some comfort in knowing the exact date that they should receive par at maturity. Now, if your investor is a total return investor, those clients will be much better served in a fund strategy that's constantly creating additional opportunities as the interest rate environment changes. So it really depends on the type of investor.
Good point. Now, as interest rates rise, what areas should we be avoiding?
The most interest rate sensitive sectors are going to be treasuries and mortgage-backed securities. Mortgage-backed securities, when we're in a rising interest rate environment, fewer people tend to refinance, so that actually extends the duration of mortgage-backed securities, making them even more sensitive to interest rate increases. Also, as you know, the Fed is one of the larger purchasers of mortgage-backed securities and treasuries right now. So as the Fed exits the quantitative easing program, that is additionally going to put some price pressure on mortgage-backs and treasuries.
Thanks, Jennifer.
Wonderful, thank you.